cloud. There we go. Francis Brown. Awesome. Good morning, Francis. It's going to show up here in a sec. Awesome. Hey, Francis, how are you? And I should make sure that, good morning. I'll make sure that you can share your, there he is. All right. Everybody can share their video. How are you, man? Good to see you.
Good. Yeah, how are you guys?
I got your email. I haven't had a chance to respond yet. I was crushed. I was like, shoot. And we'll talk about it. I was trying to twist Francis's arm to come down and join us in South Carolina, and Francis is actually leading a workshop in Salt Lake. So good for you. And I'm sorry, because you would have brought a lot to the table.
Oh, you're too kind.
Well, I don't know. I'm not really, but it's the truth.
Well, thank you.
So Bob, are you still working on technology?
My camera is not going to work, and
okay,
so we'll just go without it.
Okay, that's cool. That's party line here.
Sure.
So I'll just hand it off to you, Bob. Bob had an interesting case. I was just saying, Francis, about a client for whom changing the calendar year has a profound impact on the value of the business. And Bob, fire away.
All right. Yeah, I have a client I'm working with, and I've been working on helping him develop an alternative exit plan or transition and succession plan. And through it, I started noticing a few things, and I started thinking, I created a hypothesis based on how they were functioning, that if they changed their fiscal year, their EBITDA would go up, and thus their business value would go up. And it's partially due because they're very seasonal business. So I'm going to share my screen and kind of show you just a little graphic of this.
Okay, we can see your screen.
Okay, I'll bring it up. Everybody see that okay?
Yes. Company X fiscal year change.
Yep. So what I did is I looked at his financials, and because their big selling season is from April through August, I had them run their books for like a September 30th end of the fiscal year, October 1st. So normally they're on a calendar year, the fiscal year right here, December 31st. I had them rerun them based on the 30th, and this is what their EBITDA numbers came out to be. So if they stay at December 30th, it's 710. If they change it to September 30th, it goes to $1,074,000. And the reason that it made sense when I first looked at it is, again, if you look at a regular calendar year, their largest sales cycle here is April to August. And then they build inventory October to pretty much the next selling season. And that's when their largest purchase cycle is. Through this, as I tested this hypothesis, it just made sense that they're going to get this higher valuation. Partially because, they're purchasing stuff and building stuff for the next sales year. And at higher cost, that was going against last year's sales. The other thing is they would have higher wages, and because they're a growing business, their inventory is building up higher every year. And then there's some other things with overheads. But then I dug deep into it and I said, well, why is that? And I looked at what I believe is the normal way companies should function, right? On the far left, they order materials, comes in, it gets delivered, and then it goes either in the finished goods, raw materials, or production WIP. They add some production labor to it, and then it goes back in the finished goods. That's all on the balance sheet. When they then utilize it and sell it, it then goes against the P&L as COGS. And then of course their outgoing freight might go, it depends on how they're doing it, might go to either place. Does that seem pretty accurate from everybody's viewpoint of how you would normally run a business on GAAP accounting practices?
Barry and Jack are both CPAs, so I'm going to hold my opinion.
I know it's not the time for the CPAs.
Plead the fifth, George. Yeah, it seems reasonable to me.
Yeah, same to me. So I ran a manufacturing company, and this is how we accounted.
So that's what I thought, and I just wanted to make sure. But this is how they're running the company. They are running direct labor right into expenses, and they're running incoming freight right into the P&L. So they're running, and that's why I think they're having the problem, or why it's causing the lower EBITDA. So if you think about it, if they're doing this, then the stuff they're building in that last quarter of the year is going against last year or that year's sales, right? But they're building it for next year. So the conclusion is this would lower their taxes, but thus lowers their EBITDA. And in turn, it means if they change their fiscal year, it would improve their EBITDA. So to me, my hypothesis is correct, but how they're operating is incorrect. So my recommendation to them is they want to improve their EBITDA, and the reason they want to improve it because they want to sell in the next 3 years, is either move to GAAP practices and keep the fiscal year. EBITDA should go up because they're moving all that direct labor back into the balance sheet where it belongs, including the incoming shipping. Or they change their fiscal year and do their books the same way. Now, I believe that if they're trying to sell it and they end up in a financial review or audit, they're less advantageous to pass that if they're not following GAAP rules. So thoughts, everyone, on that?
Well, what is the effect if they change their GAAP practices, if they change their accounting method to GAAP?
Yeah, so right now, the way they're operating, hang on, I'm going to back up. Oh, mouse isn't working today. So right now they have all this direct labor and incoming freight going to the P&L.
Right.
So if they go back to GAAP practices, instead of impacting the current year P&L, it'll go in the finished goods and it'll show on the balance sheet, not against the P&L.
Right.
Yeah.
Right. So think about it. They're building inventory from in October, November, December, and their current practices makes it goes on because they're on a calendar year. That new inventory that they're going to sell in the following year goes on the existing year's P&L.
Yeah, but their accounting method is wrong.
Yeah, no, that's what I'm saying. If they correct their accounting method, then it would, they have two choices. They could keep it and change their fiscal year, which I don't recommend they do. What I think they should do is go to the correct accounting method.
Yeah, and what's interesting is what would Bob, I back your play on that, because what's the buyer going to want to see, right? When they go to market, exactly. The buyers are going to be like, well, I don't care how you've been accounting. This is how we are going to account. We're going to recast your numbers, and here's the impact it's going to have.
George, that's exactly correct.
Yeah.
Okay. So
hey,
then
Bob, I had a question. Was the owner kind of come up with this system on his own, or who came up with this method
That's
of
a great question, French.
I don't know the root cause of it, and you know, I don't know if it was his accounting, his CPA. So I'm in Eau Claire, Wisconsin. His CPA is 90 miles away, And, you know, as we're going through this transition and succession planning, I'm having him evaluate whether he has the right advisors. And for two reasons, I've decided he probably doesn't have the right CPA because of this, but also because of some answers he's given when I've had the owner ask him about his experience on transitioning businesses.
Yeah.
You know, and I won't go into the details of that right now, but I guess my question for you guys beyond this, and I thank you for your feedback, would be, now I'm not an accountant, right? I know enough to be dangerous. And as I said last week, I'm a wannabe accountant.
Yep.
So they're using QuickBooks, right? And, you know, I'm used to using more of the ERP system and setting the ERP system up. So any insight in how and what you need to do with QuickBooks to get back to GAAP practices? I mean, I don't know QuickBooks enough so that's the next stage I'm probably going to have to dig into.
Yeah, you're going to want to collaborate with someone who does this. You know, one of the points you've made, Bob, which is spot on, it actually goes to Michael Butler's webinar here a couple of Wednesdays ago, is, hey, you better make sure that your CPA and your attorney especially have transactional experience.
Exactly.
Well, Jack, you can correct me if I'm wrong, but if IRS were to get a hold of this, they would revert it back to GAAP. This is not a GAAP. I mean, this is an IRS issue as well. So I would leave everything the same and recast the numbers for the or I would change, you know, I mean, I don't know what I would do. I'd probably change it to GAAP.
I think there's just 1,000 pieces of information that are still missing. I don't know the revenue size of the organization, but you know, it's been my history. If you ask a client, do you want to spend an extra 50,000 in taxes to do it right? I've never had a taker yet. You know, I've never said I want to do it right. And so I think what's happening is you're coming up against two conventional wisdoms here. If you want to save taxes, they were doing it exactly what they needed to do. And it depends on their revenue size if they could actually get away with that. But
Jack, just so you know, they're about 5.5 million.
Oh yeah, no, I wouldn't change the fiscal year for that anyway. I think that what you're up against is two games, one to save taxes and the other to maximize the value of the organization. And I think that comes into your skills in terms of how you present it, because like everybody kind of noted right away, like you could make these changes and then someone would go back and say, I don't care. So, you know, the presentation might show, hey, we've been doing this for tax purposes, but here's what the true financial position looks like for purposes of selling this. This is what's going on in here.
And Jack, to build on that point, and guys, I'd love your input. You know, if I look at this from a buyer's perspective in due diligence, how long is it going to take I think it's a when, not if, that the buyer is going to say, hey, by the way, you have a contingent tax liability here, and we want you to insulate us from it. Guys, any thoughts?
Well, that's
meaning the IRS could look back and come after us as the new owners.
Yeah, especially if you bought the stock, right?
Yeah.
I've never been a big fan of changing the entity type or the fiscal year. They are what they are, and you learn the rules around those and manipulate those instead of trying to change. Every time I've been involved in something that changed, it was more expensive, and I don't know if it really led to the outcomes we were hoping for. So,
yeah.
Well, Bob, do you have knowledge as to what the real effect would be if they were to convert it to a GAAP basis?
No, not yet. I mean,
because
all I can do is base it on the fact that if they changed their fiscal year, I'd have to assume that they'd be somewhere in the at least a $100,000 to $200,000 change or 100 to 300,000 in EBITDA if they move that direct labor and incoming freight. So they bring a lot of stuff from overseas, so they have a lot of incoming freight, and they keep it separate, which is fine. It's okay if you want to keep your incoming freight separate, but that really goes against your materials, and they're expensing it.
Well, yeah, but at the end of the day,
would the EBITDA be sustainable over several periods? I had someone point out to me that they average the EBITDA, and so I'm wondering, you might have a 1 year win here, but over time, would the EBITDAs level out if you're just changing years?
If you look at it, 2018, the EBITDA would have changed. 2019, the EBITDA was favorable. 2020, I throw out because they were severely impacted by the
COVID
pandemic. And because they're on a growth, I would say yes, it's a sustainable change in EBITDA from what I'm looking at. But I'm more than happy to see what you guys think.
But at the end of the day, whether they report the expenses in 1 year or the next, isn't it going to even out? And if they have losses in 2020, I'm just talking out loud here. These losses will either be carried back or carried forward, depending on the situation. So, I think there's a piece of the fact pattern that you don't really know, which is, okay, what is the effect if we did option one versus option, did option one? I would take option two off the table, but that's personally.
Yeah, you would say, look at what it's going to do if you go back to GAAP practices, which
if you
ultimately they should do anyhow.
Yeah.
Well, yeah, if they restate this for purposes of the valuation, number one, and number two, for purposes of just understanding the whole problem, and three, to carry it forward properly. What is the real effect on it?
Yeah.
Because a buyer is going to want to know what that effect is. And it may be minimal.
And it might, you're right, it may be. And the only way is really to move back to GAAP practices and see what it is. Do you think they have to go back? Could they just go to GAAP practices starting in 2022 and not go back and redo their taxes? Or do you think they really have to go back and redo the taxes?
Well, I don't know if they have to go back and do the taxes, but they should at least find out what the effect is of going back.
Yeah.
Because a buyer is going to want to know, okay, we know you guys have not been accounting for your inventory and your cost of sales correctly. What's the real effect of doing that?
Yep.
It's a different presentation to a potential buyer.
Yeah.
Right.
I mean, the conversation to me is uncomfortable anyway. But if you can quantify it and understand what that effect is and deal with facts, then rather than know what you think it is, then you really, you can sell it.
I really think this is a case study of what I was talking about last week, George, in that if you manage your business for tax savings, you're destroying the value of the company. Yep. And it's not really a GAAP issue, it's a value issue. Most businesses are not run to maximize value. And especially in a closely held environment, it's sort of like the interest is in minimizing taxes. But I think that's what's going on here. And as you get closer to that exit date, you have to make some changes. So you were saying earlier that if we change the fiscal year, it'll cause a tax increase. Well, instead of going through all that, if you started saying, well, maybe instead of expensing that inventory, we leave it where it is because that gives us more income and increases our EBITDA. So it's, I know it sounds counterintuitive for a CPA to talk like this, but this is what managing for tax reduction does to the value of a business. And they could, if they just started doing a few things right, they would pay a little bit of incremental tax increase over the next 3 or 4 years, but that's where they would then realize the value in their EBITDA increase. So
yeah,
sorry about that.
Yeah. No, because every dollar is worth a heck of a lot more than a dollar.
Yeah. And I've got, you know, now the owner is really looking to sell. So he's right now he's planning on doing what he needs to do to maximize the value. And so I think I can convince him the best thing he can do is go back to GAAP practices and move forward from there.
You know, it's interesting, Bob. I have 2 other questions. So when we think about this business, when would he optimally like to take it to market?
Well, interesting. He took it to market through a big M&A firm that I've heard nothing really good about. In 19, and then he took it off the market in 20, and he's looking to put it back on. And because they've locked him in for a 4-year period, they're actually reinitiating as we speak. And I said I've heard enough about that M&A firm that I would not go with them. But as long as they're willing to give them an out in 12 months, because if they were going to sell it, they should have been able to sell it. And they really only brought one prospective buyer who really didn't even look under the hood. So,
yeah.
And I'm not so sure he's going to get this thing. He's trying to get a strategic buyer to take it. I don't think it'll work as an add-on to a private equity. So really, I came in saying, let's look at an alternative plan. And as I opened up the hood and really looked at it, there's plenty of things that need to be done at this company.
Well, what's interesting is that you end up with if he's not going to be able to sell it in the next 12 months, it may already be too late. And he's going to need to get a few years of running, the books under the new system. He may end up with a time to market issue, which is unfortunate for him. But if we go into a recession, who knows? Times are interesting, what impact that'll have on the deal market, and specifically in his space. But he may end up having, how old is the guy?
62.
62.
And he's okay not selling it for 3 years. And
okay.
Worst comes to worst, he'd hang on to it longer.
Got it.
What's his target sales price?
His target sales price?
Yes.
He just keeps going to 5x EBITDA.
Okay, so at least he's relatively realistic.
Yeah, but I don't think he's going to get that unless someone really picks him up more for a strategic buy.
Have you run?
I think he's somewhere between 3.5 and 4.2. If I was going to ballpark this off the top of my head, because there's, he's getting to that level there that he needs to start growing up, right? He's too big to be small and too small to be big.
Yeah. Have you run core value on him?
No, not yet. Okay. No, I'm just trying to get him past
this
one stage at a time.
Yeah, I hear you.
It's on the list.
Guys, I got to take off. I got to head to another call. Good to see y'all.
Francis, good to see you, man.
Yeah, Francis.
Bye.
You guys got anything else?
Oh, it's fascinating. I'm looking forward to seeing how it unfolds.
Yeah. I meet with him tomorrow to go over this and his management team. I think I'm optimistic that they're going to do the right thing.
Yeah.
But again, it's their choice, not mine.
Yeah, well, especially if he understands that he might be put, the various impacts that this can have on him personally and on the value of the business.
Yeah.
We know what the consensus is around this table.
Yep.
Yeah, interesting.
But I can make not a comparison, close comparison, but I'm working with a company that, for whatever reason, failed to report about $50,000 of their revenue. And I told them to go back and amend the returns. They want to just slide it into the following year. And I said, well, a buyer's going to, first of all, it's not the right thing to do. I said, second of all, a buyer's going to look at your integrity and,
yeah,
they're going to make sure that they're dealing with people that are, stand-up people. Mm-hmm. So they went to their CPA, and I guess their CPA, who's also their attorney, which is a disaster anyway. Either attorneys can't make enough money or CPAs can't make enough money, so they have to do something else. In this particular case. And so they amended the returns.
That's great advice and the smart thing to do.
And what was interesting too is the investment bankers that they talked to. One of them was more like a broker, and one of them was a true investment banker. And the investment banker said they shouldn't sell the company right now, and listed a number of different things that if we fix, which will only take 12 months, they can get 1 times earnings versus 5 times EBITDA. And there's a $2 million difference. So we'll find out which way they're going to go tomorrow. But it's
interesting.
It's
interesting.
Yeah, man. Terrific topic, Bob.
Yeah, I appreciate being able to discuss it. Appreciate everybody's insight. So
sure, but in a few weeks, months, whenever this plays out, let's bring the topic back. We're here every Tuesday.
All right, sounds good. I got to run.
Good luck.
Thanks, guys.
Take care.
Thanks.
Have a great day, everyone. Bye.